Let's go ahead and get started. Happy Friday, everyone. Welcome aboard to our weekly Outlook webinar. This is Ilian Yotov, founder of allthingsforex.com and a host of the popular All Things Forex daily broadcast. Make sure to visit allthingsforex.com and register as a member. Membership is free of charge, unless you want some of the premium services, of course. You can attend the live programs or listen to the daily broadcast archives available on the members page of allthingsforex.com. I'm also the author of the book, The Quarters Theory, the Revolutionary New Foreign Currencies Trading Method. Welcome you to discover for yourself this new methodology for trading foreign currencies. You can find it everywhere books are sold. So without further ado, what we're here today to discuss is the top 10 spotlight economic events in what seems to be shaping up as a very important and a very crucial, potentially, trading week for the euro and the US dollar, with both of the central banks, the Federal Reserve and the European Central Bank, literally announcing their interest rate decisions within 24 hours from each other. So these are going to be obviously the top 10, the two main spotlight events of next week, but we are also going to see a lot of important economic reports besides the interest rate announcements by the European Central Bank and the Federal Reserve from both sides of the Atlantic. So we're going to start off with a sequence of U.S. economic data that will begin as early as next Tuesday. Before the Consumer Confidence Index, and I only give you the top 10 events, I could have easily put 15 or even 20 spotlight events for next week. That's how busy the trading week ahead of us is going to be. So the first of the top 10 events I've chosen to be the Consumer Confidence Index. A little bit before that, we're going to see a couple of important reports as well on Tuesday morning, July the 31st. The first report will be the Consumer Price Index, or the so-called Harmonized Index of Consumer Prices in the Eurozone, which is a preliminary flash estimate for the month of July. And that is the preferred gauge of inflation by the European Central Bank, which this report will be released on Tuesday morning at 5 a.m. Eastern Time from the Eurozone. It didn't make the top 10 list, but nevertheless, it is an important event to watch. And the reason I'm saying that it is important because if inflationary pressures are subsiding in the Eurozone, then that creates a type of environment that would make the European Central Bank policymakers more comfortable as far as continuing their policy of monetary easing, or monetary policy easing. So lower inflationary pressures certainly could mean that that inflation will not be an obstacle, so to say, if the European Central Bank were to decide to do more as far as potentially consider an interest rate cut, or maybe even do another round of long-term refinancing operation, buy bonds and so forth and so on of the troubled nations of Italy and Spain and other troubled nations in the Eurozone. The Consumer Confidence Index is going to be the first of the top 10 events that is important from the United States. But before that, on Tuesday, also, we're going to see the Fed's preferred gauge of inflation as well. So we'll see the two inflation gauges on Tuesday morning from the United States and from the Eurozone. Now, I already told you the flash estimate for the Harmonized Index of Consumer Prices from the Eurozone is due at 5 a.m. in the morning. And then the core PCE price index, Personal Consumption and Expenditures Price Index, is due to be released. It always is a part of the so-called Personal Income and Outlays report, or the Personal Spending and Income report in the U.S. A component of that report is the Personal Consumption and Expenditures Price Index, which measures a variable basket of goods and services in order to gauge inflationary pressures in the U.S. Now, this is the gauge of inflation that is preferred by the Federal Reserve because the Consumer Price Index obviously is an important gauge of inflation. In most other countries, the central banks use the Consumer Price Index as the main measure of inflation. That is not the case in the United States. The PCE Price Index is what the Fed pays more attention to compared with the Consumer Price Index. That's because the Consumer Price Index measures a fixed basket of goods and services rather than a variable basket of goods and services, the core PCE index. And both of these indexes of inflation from the Eurozone and from the U.S. Are not going to show inflation pressures increasing a whole lot. The Consumer Price Index flash estimate is expected to show inflation in the Eurozone at 2.4% year over year, while the core personal consumption expenditures price index for the U.S. is expected to only increase by 0.2% month over month, compared with the 0.1% month over month increase. Definitely not enough of an inflationary pressures pickup, if you will, that is going to change the Fed's mind to consider additional monetary policy easing. Both of these central banks are now expected to potentially continue their policy of accommodative monetary policies, both the Federal Reserve and the European Central Bank. And we'll talk about that in a few minutes. Now, let's focus on the consumer confidence index, which, by the way, is expected to show consumer confidence deteriorating, pulling back from a reading of 62 in the month of June to a reading of 61.5 in the month of July. So we have seen the consumer sentiment index declining, and now we can witness also the consumer confidence declining as well, which is not something that we should be surprised of. Many were saying, well, I think many were out there trying to pop the champagne, if you will, saying that there's already a recovery in the U.S. housing market, and the cold shower of economic data from the housing market in the last 2 weeks, I think, is an indication that this is not the case. We're not seeing very much of an improvement in the U.S. labor market in the last 3 months, because we actually bother on this webinar and on my All Things Forex program, I bother to talk about these kind of things. So looking at the lack of improvement in the jobs market, it wouldn't be logical, as I said a few weeks ago, for us to anticipate that there's not going to be any housing market recovery. The housing market is closely related and dependent on recovery in the jobs market. Well, unfortunately, in the last 3 months or so, we haven't seen that happening in the U.S. And so many may have been shocked, and you read in the media, unexpectedly, the existing home sales fell, and the new home sales fell unexpectedly. And then yesterday, the pending home sales index unexpectedly dropping. Why is that unexpected? It's not really unexpected. So the reason why I'm saying that is not to say that I'm so smart that I can figure it out. The reason I'm saying this is because this is all an economic data that we've been paying attention to in the last 3 months, if not even 4 months, and we're continuously seeing the signs of weakness from the U.S. economy. And as I have said many, many months ago, any weak economic report from the U.S. is only going to raise the odds of the Fed doing more easing, or another round of quantitative easing, the so-called QE number 3. Now, the Fed already expanded their easing operations by extending Operation Twist. And the next step is quantitative easing number 3. So this is why we shouldn't be surprised if the Fed does more. And if the U.S. economic data certainly shows us more signs of weakness, and it looks like, according to the consensus forecasts, that the consumer confidence index is not going to instill much of a confidence in the state of the U.S. economy or the outlook of U.S. consumers, then obviously this could be a report that could raise QE number 3 expectations. Now, going forward, another employment report is due, as usual, a couple of days before the non-farm payrolls report on Friday. Next Wednesday from the United States, we're going to see the ADP employment report. ADP stands for Automatic Data Processing. It's the biggest payment paycheck processor in the country, which gives them a unique ability to put together a report which tracks the creation of jobs in the private sector of the U.S. economy, not the entire economy, just the private sector, not the public sector. So the ADP employment report, which I like to call the warm-up or prelude to the non-farm payroll reports, which normally fall on the following Friday, a couple of days after the ADP report. The ADP non-farm employment change for the private sector is expected to show the economy, the private sector, creating 122,000 new jobs. fine, right? Well, not really, because in the previous month, in the month of June, the private sector created 176,000 jobs. So at 122,000, that obviously is a slower jobs creation that is forecast now for the U.S. private sector. And this could be, of course, a leading indicator of things to come with the non-farm payrolls report on Friday as well. So I'm not seeing the first two of the top 10 U.S. economic reports is instilling any confidence in the U.S. economic strength. So the labor market report on Wednesday morning is something we're going to watch. And then after that, we have the ISM Manufacturing Index, which is a gauge of economic conditions, measures the activity of purchasing managers in the manufacturing sector of the U.S. economy. Now, unlike the manufacturing and the services indexes in the Eurozone or in the United Kingdom for that matter, the U.S. manufacturing and non-manufacturing indexes have managed to stay above 50 for pretty much the last, what was it, like 30 consecutive months, if I'm not mistaken. I might be mistaken, but for a very long time, they managed to stay above 50, which is the dividing line between economic expansion and contraction. Well, last month in June, the manufacturing index surprisingly declined below 50 with a reading of 49.7. As we didn't have enough signs of the U.S. economy slowing or manufacturing and services activities weakening, the manufacturing index was a warning sign as well that things are deteriorating as far as U.S. economic conditions. So a reading of 49.7, for the first time in many, many months, the manufacturing index dipped below 50. Now, the manufacturing index on Wednesday, with the report on Wednesday for the month of July, is expected to see a reading above 50 again, so climbing above 50 with a reading of 50.4. If this is not the case, then obviously that could be another, and the ISM manufacturing index stays below 50, then that could be another weak economic report that will only raise the probability that the Fed is going to do more easing and could potentially announce it as early as its interest rate decision announcement, which is due on Wednesday at 2:15 p.m. Eastern Time. Apparently, on Wednesday, the announcement is at 2:15 p.m. Eastern, which is different than other two-day meetings. Normally, after a two-day meeting, the Fed announces their decision at 12:30 p.m. Eastern Time, and then a press conference follows at 2 or 2:30, if I'm not mistaken. Well, that's not going to be the case. There's no press conference for next Wednesday, so just the Federal Open Market Committee statement and their decision on interest rates and monetary policy, which doesn't mean that the event is not going to be important. It actually is going to be a very crucial potential event for the future fate of the U.S. dollar, especially if the Federal Reserve decides to announce another round of quantitative easing, or the so-called QE number 3. The reason why the odds of QE 3 announcements have been increasing is what I explained earlier. We've been paying close attention to economic data throughout the second quarter. Well, we pay attention anyway to any month, but especially in the second quarter, we have not seen any kind of strength in the U.S. economy. And the report this morning, by the way, the weaker GDP report, which is only the preliminary estimate for U.S. economic growth in the second quarter of 2012, showed the U.S. economy growing as expected at a slower pace, from 1.9%, which was revised higher, to 2%. So from 2% in the first quarter of 2012 to 1.5%. That's 1.5% in the second quarter of 2012. Now, some are getting excited and saying, oh, well, this was better than expected because the consensus forecast was for 1.4%. Well, the consensus forecast range was between 1.3 and 1.9%. So with a reading of 1.5%, this is at the lower end of that target, the forecast range. And by the way, this is only a preliminary estimate that shows 1.5%. These numbers can be revised in the next couple of months. And if they are revised lower, in other words, if there is a downward revision in a GDP estimate for the second quarter, which I'm not excluding the possibility of. I think that there will be actually a downward revision, and we're going to end up seeing either 1.3 or 1.4% only growth in the second quarter of 2012. Then this is another report that we saw this morning that shows and confirms the market's expectations that the U.S. economy is slowing, that economic conditions are deteriorating, and that the Fed may not have any other choice but to continue its accommodative monetary policy, perhaps even announcing another round of quantitative easing. And this is why we should not be surprised if that announcement were to come as early as next Wednesday. Now, obviously, and I will switch us over very quickly, as I have been explaining on my daily program, the All Things Forex broadcast, I have said do not be surprised to see the U.S. dollar coming under pressure in the days leading to the Fed's interest rate announcement. Now, why would I say that? Well, of course, if the market is pricing in that the Fed might do another round of quantitative easing, that's definitely not a U.S. dollar positive. And so it's not really that shocking to see the U.S. dollar coming under pressure versus the higher-yielding commodity currencies such as the Australian dollar, or even versus the euro, which has a ton of problems on its own, but it's managing to capitalize on this market expectations that the Fed will do more easing, possibly as early as next Wednesday, and it's triggering a nice little relief rally here and a price correction for the euro versus the U.S. dollar, during which the euro is correcting some of its losses versus the U.S. currency. Yesterday, the euro, 3 days ago, or 4 days ago, I should say, the euro managed to bounce off of a new two-year low at the $1.2041, which was reached on the 24th of July. And then in the last three trading sessions, you can see this rally of the euro versus the U.S. dollar. Why is that? Because the European debt crisis all of a sudden got fixed? Not really. It's all quantitative easing expectations. Well, some will say the European Central Bank president said yesterday that the euro project was irreversible. Okay, so that instills some confidence that the European Central Bank is going to print a whole lot of more money and expand its already inflated balance sheet to record levels, even higher than a greater amount than the Federal Reserve. Is that why the market's getting so excited? Well, we'll see. We'll find out. But I think that this is just an opportunity here for the euro to take some of its to correct some of its losses here in the last couple of months, or at least the last month versus the U.S. dollar, and it's now moving to levels that are being approached that used to be previous support levels. It was the bottom of a channel that was established a weekly or even a monthly range for the euro-dollar exchange rate. To refresh your memory, and I haven't done these webinars in a while, so I'm pretty sure we talked about it a month or two ago, but let me refresh your memories. The euro-dollar exchange rate was stuck in a range between $1.34 or $1.24 rather, and the large quarter point, which is an important price level in my quarters theory, at the $1.2750. And this is where the euro-dollar exchange rate was fluctuating pretty much in, starting from the 7th of June until the euro broke below $1.24 on the 5th of July. So about a month that we saw the euro-dollar exchange rate trading within about 300 to 350 pip range, give or take. The top of that range was $1.2746, which I'm sure was a complete coincidence, being only 4 pips below $1.2750, the large quarter point there. And then an identical high was established there that the euro failed to break above the top of this range at the $1.2742 a couple of days after that previous high was established. So it's more than obvious that $1.2750, large quarter point, served as the top of this range. Then $1.2434 was serving as the bottom of the range, which was the low from June the 8th. Now, that low was tested here. It was not broken below. It was tested also in this couple of days. It was not broken below. It finally was overshot below with a low at $1.2406 on June the 28th. But the euro then sharply moved higher. It bounced off of the $1.24 level. It did not break above the top of the range and then headed back to the bottom of the range. And then after that, the rest is history. $1.24 level was broken below. We saw the euro dropping to $1.2362 on the 5th of July, and then that opened the door for a challenge of the support level at $1.2286. We broke below that level, and then the euro managed to produce new two-year lows after that, and that was the low 4 days ago at the $1.2041. So on the way up during this price correction, as the market prices in expectations that the Fed will do more, especially after another negative report this morning that showed the U.S. economy growing at a slower pace, we are seeing the euro climbing now towards the $1.24, $1.2434 range, which used to be the bottom of this weekly range throughout the month of June. So it wouldn't be surprising to see the euro bumping against that resistance. Of course, these previous support levels will be important levels of resistance. And $1.24 to $1.2434 area is going to be the area that we're going to watch very closely, because if it's not broken above, then the selling interest in the euro is going to only increase further. And as I said earlier, even if the Fed were to do more quantitative easing, that of course means further debasement of the U.S. dollar. The initial reaction to that is not going to be a U.S. dollar positive, but ultimately, if the size of QE number 3 is smaller, which that has been the case, at least that has been the trend, QE number 1 was larger than QE number 2, and QE number 3 is more than likely not going to be larger than QE number 2. So if the Fed refrains, on the other hand, if the Fed does QE number 3, initial reaction, as I said earlier, will be U.S. dollar negative, especially in a build-up to the event, in the days leading to it, as the euro is strengthening, as we're witnessing here, in the days leading to the Fed's decision on Wednesday. But ultimately, if the size of QE number 3 is lower, and if it's months and months ago, I talked about an article in Wall Street Journal which was discussing what the next QE number 3 might look like. And the word sterilized quantitative easing was used. In other words, in this article, there were some sources at the Fed that have told the Wall Street Journal that the Fed is considering QE number 3, but they're considering the so-called sterilized version of it. In other words, they're going to print more money to buy more bonds, but ultimately tie that money into borrowing it and then repaying it at a lower rate or some complicated thing, and I can't really dig it out right now. But ultimately, it will be the type of quantitative easing, the so-called sterilized quantitative easing, because it's not going to increase inflationary pressures. The money is going to be tied in, and then use the proceeds of these funds and use what they buy, these bonds or whatever, as a collateral, and then turn up and buy shorter-term securities or something like that, some complicated scheme that the Fed is considering. But ultimately, the impact is not going to be that much on inflation as QE number 1 or QE number 2 may have had. So this is ultimately news that we're about to potentially witness as early as next week. So it's going to be important what kind of quantitative easing, if the Fed were to announce another round of it, in the form in which it's going to come. And ultimately, the markets will gauge that. But if it is a sterilized easing, or if the Fed simply refrains from announcing another round of quantitative easing on Wednesday, then we could easily see the dollar selling pressures easing, and then ultimately the euro put under pressure on expectations that the European Central Bank 24 hours later, after the Fed, even less than 24 hours after the Fed announcement, is going to also consider further monetary policy easing of their own. And so we'll talk about that as well in a few minutes. So we're going to watch this resistance area, previous support, future resistance area here. If the euro is having problems overcoming this resistance, then that would be a sign of weakness, and then we can see the euro selling pressures increasing once again, especially if the Fed were to refrain from doing another round of quantitative easing. The Fed's already done more easing in a form of extending Operation Twist. They pumped another $267 billion worth into the U.S. economy by extending Operation Twist. And some are saying the Fed might do QE number 3, and then on top of that, they might even extend the period of the promised period of record low interest rates. The current time frame that the Fed has given us is late 2014. Now, some experts are saying the Fed might change that time frame to late 2015, which would be another extra year of record low interest rates. I mean, record low interest rates are not really helping, are they? The mortgage rate here in the United States, the 30-year mortgage rate is 3.6%, if I'm not mistaken, 3.5%, even close to 3.5%, which is a record low. Never before has a mortgage rate here in the United States, 30-year mortgage rate, has been at this level. And still, we're not seeing a recovery in the housing market. Why is that? Well, as I said earlier, it is the jobs market that is faltering. And speaking about the jobs market conditions, the days to follow on Thursday of next week, after the Fed's announcement on Thursday morning, we'll see the jobless claims, and then on Friday, even more important jobs report. The mother of all important economic data from the U.S., which is the non-farm payrolls and employment situation report. Now, let's go ahead and go forward with our top 10 events. The sequence of interest rate announcements by major central banks after the Fed is going to continue with the Bank of England's interest rate announcement on Thursday morning. The Bank of England, in early July, at their latest meeting, decided to expand the size of its so-called asset purchase program, which means more quantitative easing, another 50 billion pounds worth of it. And certainly the Bank of England might continue to do that once that 50 billion has been put in place, but it's going to take a little bit longer than a month for the Bank of England to wrap up that current extension. So I don't think that the Bank of England is going to announce another round of quantitative easing that soon, a month later after the recent announcement. However, what we're going to watch very closely is if future quantitative easing expansions, which I'm not excluding, I think the Bank of England will probably pump even more money into the economy. If future expansions of the quantitative easing operations of the Bank of England are actually combined with an interest rate cut, which will reduce the yields of British pound-denominated assets, bonds, treasuries, or the so-called UK gilts, government bonds. Which I think that ultimately that would be something that could weigh on the British pound in a very big way. If the Bank of England were to not only be expected to increase the size of their quantitative easing operations, but also to cut interest rates as well. And that would be a double whammy of negativity for the British pound. Definitely something to watch with the announcement next week. No change is expected, however, to come with the Bank of England's monetary policies next Thursday. This is also, by the way, the expectations for the European Central Bank meeting on Thursday morning as well. The European Central Bank already cut the record low interest rate at 1% by 25 basis points to a new record low level at 0.75%. The cut happened after the Fed's decision in June to extend Operation Twist. And in June, I called the Fed's decision a policy guiding decision for other central banks. Here's what I meant by that. The Federal Reserve was the first major central bank to have their meeting and announce their monetary policy after the second round of the Greek elections and after the European Union summit. And so, with the Fed's decision to do more easing, this was a signal to other central banks, and the policy guiding decision of the Fed triggered other central banks to offer more easing as well. It led to the European Central Bank's interest rate cut, and it also led to the Bank of England's decision to expand the size of its quantitative easing program. Obviously, there's organized action by major central banks such as the Fed, the Bank of England, the European Central Bank, and I'm going to have to include the Bank of Japan to that list because on the 9th of August is when the Bank of Japan is more than likely also going to announce additional expansion of its quantitative easing operation. So more easing also by the Bank of Japan is what I'm expecting, and I'll talk about that. Well, probably not next week because we're not going to have our webinar next week because of the 3-hour webinar on the non-farm payrolls that FX Street has, but we'll continue the Friday after that, and keep an eye on the Bank of Japan. I think that they're going to also do more easing in line with the other central banks. So in June, the Fed's decision was a policy guiding decision for the other central banks, and this is why I think that we should watch the Fed's decision on Wednesday as well to find out if the Fed does more easing, because that could be a hint that the others, the rest, are going to follow the Fed's footsteps, which if the Fed were to announce QE number 3 or any other kind of form of quantitative easing or monetary policy easing, then I wouldn't be surprised if as early as the next morning the Bank of England and the European Central Bank also announced something as well. Now, the three options that I have been talking about for months that are ahead of the European Central Bank are still the same. First, they can buy more bonds to ease the pressure of rising borrowing costs in Spain and Italy. I think the European Central Bank's president's statement yesterday that not only he said that the euro is irreversible and that the European Central Bank will do whatever it takes to save the euro and bring borrowing costs down, that's a hint that the European Central Bank is prepared to buy more bonds. This kind of operation, however, was questionable as far as how successful it was. I mean, it provided a temporary relief in borrowing costs for troubled nations, but ultimately, the European Central Bank, was it a year ago, last summer, that started buying bonds of Italy and Spain? It helped for a month or so, but then after that, we most recently said even these last few days, we continue to see rising borrowing costs for both of these countries. So even if they announce another round of bond purchases next Thursday, it still is going to have probably just a temporary effect on the markets. In other words, I don't think it's going to curb rising borrowing costs in the longer term. On top of that, if the European Central Bank were to announce that they're going to buy more bonds, what are they going to buy it with? Well, they're going to have to print some more money. So, as I said earlier, that expands the already inflated balance sheet of the European Central Bank, and although the initial reaction might be euro positive because it's going to bring borrowing costs in Spain and Italy lower, though in the long run, the European Central Bank is about to take on a lot more, a bigger debt load. The second option is LTRO number 3, or another round of long-term refinancing operation. Now, especially that we're not only talking about banks going to borrow from the European Central Bank to recapitalize themselves. Now there's talk, as we witnessed earlier this week, apparently, according to some of the members there at the European Central Bank, that some policymakers are having discussion on whether or not they should give the European Stability Mechanism, that is the supposedly permanent bailout fund, which is long overdue, by the way. The European Stability Mechanism was supposed to get activated in early July. Well, it is July 27th today, and the ESM, the European Stability Mechanism bailout fund, is still not activated. As a matter of fact, we're waiting for the High German Court to decide whether or not it is constitutional, the ESM. So there's a lot of hurdles ahead of the temporary fund before it's activated. But when it gets activated, the big question is, where is the money going to come from to bail out Spain? Supposedly there's 500 billion euros there in the European Stability Mechanism, and only about 160 billion euros left in the EFSF, which is the temporary bailout fund. 160 billion euros in EFSF is not going to be enough to bail out Spain because the latest estimates are that Spain is going to need 300 billion euros at least. That is on top of the 100 billion euros for the Spanish banks, which were approved of the bailout for their banking institutions. So the big question is where the money is going to come from, and the market, the euro rallied on the news that there are some discussions at the European Central Bank that the European Stability Mechanism will be given, potentially considering to give the European Stability Mechanism, the bailout fund, a banking license, which I think is a good idea because it's going to allow the ESM, just as the other banks, to go to the European Central Bank and ask for money. The European Central Bank's going to print it, they're going to lend it to the European Stability Mechanism, and then they're going to have as much money as they need to bail out both Spain and Italy, where they're going to need a lot more than 300 billion euros to bail out both of these number 3 and number 4 largest economy in the Eurozone. Estimates are that at least over a trillion euros is going to be needed to bail out both of them, Spain and Italy. So if the European Central Bank were to do another LTRO to recapitalize banks or to add more money to the European Stability Mechanism, that's another way to expand its already inflated balance sheet. It's hard for me to see this as a euro positive in the long run. And then the third option, of course, is an interest rate cut that the European Central Bank has as an option to consider more easing or to try to spur economic growth. Well, an interest rate cut is also something that I don't see as a euro positive, especially if you notice the market's reaction after the European Central Bank cut the rate last month or early this month by 25 basis points. It reduces the yield advantage of the euro over other lower yielding currencies. It reduces interest rates, and ultimately we saw the euro being put under pressure as a result of the interest rate cut by the European Central Bank earlier in the month of July. So the third option that the European Central Bank has to do more monetary policy easing is also not a euro positive. So we'll see which poison the European Central Bank is going to choose. Maybe not just one of these three options, maybe two could be used, depending on what the European Central Bank policymakers decide. But it will be an interesting day as far as future monetary policy of this major central bank, and it will be an interesting decision that could be a make or break decision for the euro, especially now that we're seeing, as I showed you earlier, the euro going through a nice little price correction versus the US dollar correcting some of these losses, bouncing off of 2-year lows. If the European Central Bank were to do more easing, cut rates, expand its already inflated balance sheet, the selling pressures on the single currency could increase very, very quickly. And the selling interest in the euro is only going to start increasing the higher it goes. I don't think that this price correction in the last couple of days that we're seeing for the euro versus the dollar is a reversal of the negative trend for the single currency. There's still a ton of issues ahead for the euro. There's still political and structural problems there in the eurozone and flows in the eurozone and the European project that have to be addressed. The European Central Bank can do whatever it takes to save the currency. They are going to save it if they have to, and they may need to. But ultimately, I doubt that that would reverse in a big way the downward trend that the euro has established here in the last year or so versus the US dollar, or the last couple of years. Going forward with the sequence of economic data for next week, on Thursday, we're also going to pay attention to the U.S. jobless claims. Very volatile jobless claims in the last several weeks, especially big swings, if you will, from 350,000 to above 380,000, and then yesterday, surprisingly, again down to 350,000. Bloomberg asked the Labor Department in the U.S., saying, "Okay, what's going on with all this volatility? What should we believe? What's the story here?" Labor Department said, well, there were some hirings, there were some firings in the summer months, there were some plants, car plants, or some factories, car factories, that were hiring and firing, and that's what kind of skews all the jobless claims numbers. It's an important gauge of labor market conditions, obviously, because it tracks the first-time claims for unemployment benefits. It's one of those job market reports that I've been talking about since the beginning of 2011, and the magic number there is 375,000 Economists are estimating that if the jobless claims manage to drop below and stay below 375,000, that's a good leading indicator of improvement in U.S. labor market conditions. With all this volatility, we have seen a couple of drops below 350,000, but for the most part, in the last couple of months, jobless claims have not been very impressive. This is something to watch. Once again, if they jump and spike higher again, then that would be another sign of a lack of improvement in labor market conditions in the United States. That's going to lead us to the Eurozone retail sales on Friday morning, an important measure of consumer spending. Last night in Japan, very disappointing retail sales report. Eurozone, obviously, big buyer of Japanese exports. Eurozone is, I think that it's the well-known secret. The Eurozone is pretty much everyone is expecting it's in a recession. Miraculously, last quarter, the higher than expected German GDP was able to lift the overall Eurozone GDP numbers to show flat 0% reading. Consensus forecasts were expecting another second consecutive quarter of negative economic growth in the first quarter of 2012. I don't think that Germany is going to save the reading for the second quarter of 2012. I think the Eurozone is going to be in a contraction. We'll see a contraction in the Eurozone economy. And the retail sales are more than likely going to be a contributing factor. Lesser consumer spending is what we are expecting with the consensus forecast for the Eurozone retail sales on Friday, 0.1% only month-over-month increase compared with 0.6% month-over-month in a previous month. Another economic report from the Eurozone, which, by the way, could show economic weakness there. And I didn't include the final readings for the services purchasing managers index and also the manufacturing purchasing managers index from the Eurozone next week. Those final readings are due next week. The services is on Friday at 4 a.m. Eastern time. The manufacturing is on Wednesday from the Eurozone. And I didn't include them because we already had the preliminary estimates for these two reports last week. And neither one of them was a very positive one. Both of the purchasing managers indexes from the manufacturing and the services sector in the Eurozone economy showed readings below 50. So that means they were in contraction territory for another month. And the reports next week from the manufacturing and services purchasing managers indexes can also give an indication that conditions are not improving. As a matter of fact, that they are deteriorating for another month in the Eurozone economically. After the Eurozone retail sales, it will be time for the third most important economic report next week. It's coming from the U.S. with the non-farm payrolls and employment situation. In the world's largest economy, it's the main indicator of U.S. economic health, measuring unemployment, job creation of private and the public sector of the U.S. And the non-farm payrolls reports in the last 3 months have been nothing but a disappointment, as I have said all along throughout this program. We have been paying very close attention to the lack of improvement from the U.S. jobs market. And last month, actually in May, we were expecting a little bit of a stronger jobs creation. That was not the case from the U.S. economy. It only created 80,000 jobs on expectations for 120,000 jobs. In the month of July, the forecast is for the U.S. economy to create about 101 to 110,000 new jobs. If that number is lower than the consensus forecast, and if it is lower than 80,000, then this would be another negative, disappointing non-farm payrolls report. And that even if the Fed were to refrain from announcing QE number 3 on Wednesday, only a couple of days later, if the non-farm payrolls report is another disappointment, we are going to continue to see QE number 3 expectations being priced in. And the market can start even pricing them even more aggressively, even if the Fed were to refrain from announcing QE number 3 on Wednesday. If the non-farm payrolls is disappointing, the market could start aggressively pricing in QE number 3 to come with the Fed's announcement on September the 13th. That is the next time that the Fed is going to have a meeting and announce its decision on interest rates and monetary policy. The unemployment rate as part of the non-farm payrolls and employment situation report is expected to stay stubbornly above 8% for another month. 8.2% unemployment is what the consensus forecast is. All of that quantitative easing, all of these record low interest rates are not helping bring the unemployment below 8% in the last several years. Obviously, something is wrong there, and if the non-farm payrolls confirms these expectations, then, as I said earlier, the dollar could stay under pressure on QE number 3 being priced in. And the final of the top 10 spotlight events next week is going to be the ISM non-manufacturing index from the services sector of the U.S. economy. The services index is expected to stay above 50 with a reading of 52.2. That is slightly higher than a 52.1 reading in the previous month. In the last few months, the ISM non-manufacturing index has also started to decline, heading towards the 50 level, which is still hanging on above 50, which is not as bad as the Eurozone services index, which is in contraction territory, as expected to stay in contraction territory, as I said earlier. But definitely another sign of a slowdown there from the non-manufacturing services sector of the U.S. economy. Before we wrap things up, let me look at a question that comes from one of our listeners here. Jose says, so you say that large investors are speculating that Spanish bond prices should rise because of the European Central Bank purchases, and then they later sell and jump back to the U.S. Well, I mean, it could happen, but it will be interesting to see whether Spanish bond prices or yields or borrowing costs are going to rise or fall. If the European Central Bank announces that they're going to buy Spanish and Italian bonds, yes, probably that's going to be the case. But certainly we're going to have to wait and see what the European Central Bank is going to decide. Good question. Thank you, Jose, for your participation in the program today. Unfortunately, we're running out of time. The All Things Forex live daily broadcast is a daily program Monday through Friday on my website, allthingsforex.com. Make sure to check it out. Listen daily at allthingsforex.com, and you can also follow me on Twitter at allthingsforex is the account. Thank you all very much for attending the webinar today. I will be back in a couple of weeks. For now, I'd like to wish you a great day and a great weekend. And